Hi, I'm Greg Welborn with First Financial Consulting in Pasadena, California. Today's video is meant to be a follow-on to the investment survey that you just took. You'll notice that I'm standing behind a chart called Investing 101. And we're going to walk you through in a little bit greater detail how to structure an investment portfolio. Now, you probably noticed when you took the survey, it asked a lot of objective, factual questions. How old are you? Your income, net worth, investable assets, how long do you have to retirement? How much debt are you going to have to take care of? Those probably all made a lot of sense to you. But it also asked some what we call feeling questions. How do you feel about this if it happens to the stock market? How do you feel about your investment knowledge? How do you feel about or what's your experience with bonds or stocks? The reason that we're asking those feeling questions is that all of us, myself included, we're part rational, but we're part emotional. We call it the head and the heart. And ultimately, the two have to work together if you're going to structure an investment portfolio to accomplish your goals. Now, if we turn to the chart here, you'll notice pretty simple graph. We've got dollar on the vertical axis here. We're going to start with about $10,000, assume that's what our portfolio is today. Along here, we're going to go in time. We've got 1 year, 2 years. We're going to go out to about 20 years. I've got two lines on this chart. One represents a 6% average annual rate of return. Click along at $10,000 when we get out here in 20 years and we've got $32,000. The other line is 12%. Clicking along here at 12%, start with 10,000. We're going to end up in 20 years with $96,000. None of this is guaranteed. I don't want to imply that. There's no such thing as a guarantee in the investment world, but these are very realistic numbers. We believe that a 6% average annual rate of return is achievable. We also believe that a 12% average annual rate of return is achievable. Now, assuming that you've got 20 years, 25 years before retirement, before you need this nest egg, why wouldn't you take 12%? Why would you possibly settle for 6%, 10 grand growing to 32,000 when you could get 10 grand growing to 96,000? The reason for that is it never really happens like this. You never really get 6%, 6%, 6%, 6%, 6%. Instead, you get something like this. You get some years where you're earning more than 6%. You get some years where you're earning less than 6%. In fact, there might be a little bit of a loss in some years. And you go some highs, some lows, and you end up at 6%. Looks pretty good, right? Here's what happens, on the other hand, if you want to shoot for 12%. Again, it never happens. 12%, 12%, 12%. This is what this pattern probably looks like. A lot of that is pretty intuitive, right? If you're going to take a higher rate of return, you probably think, I got to accept some greater risk. But what does that really mean? We don't like to talk in terms of conservative, aggressive, or balanced. It means different things to different people. We want to talk in terms of real volatility. Real highs, everyone loves those, but real lows, and no one likes those. If you want to get 12%, you want to go from $10,000 to $96,000, you have to put up with this pattern. You essentially have to put up with this high dropping down to this low. This is the amount of volatility. If you can't do that, maybe you're willing to take something that's a little bit more like this, much less volatility. This is what we're referring to as that head and heart, why we're trying to balance those two together. Logic tells you if you've got 20 years, and if I'm telling the truth, you can earn a 12% rate of return. You can get $96,000 out of $10,000. Logic, defendable. Why wouldn't I do it? Because emotionally, you might not want to put up with this. That sounds easy to say, but here's the truth and why I say that. And I'm quoting from the same newscaster about 9 months apart. Quote, and he's right here. It's a new paradigm. The old rules of investing no longer apply. The sky's the limit. So what did George and Martha Investor do? They get into stocks, heavy. 9 months later, same newscaster, right down here. It's the worst recession since the Great Depression. George and Martha get out of stocks. And unfortunately, what they do is they replicate that. They buy high on greed, they sell low on fear. High on greed, low on fear. They take what would have been a winning long-term average annual rate of return of 12%, and they translate that into a personal rate of return of, the study showed, this was real, most Americans during a 10-year period of time when stocks went up 10% per year on average, most American investors translated that into a minus 2% per year personal loss. Greed, fear, greed, fear. So the reason in our survey for all of those logical questions and those emotional questions was to help you figure out, where do you belong between these extremes? What amount of volatility can you take before you bail like our George and Martha here and take a really good, strong average annual rate of return and convert it into personal loss? We want to help you prevent that from happening. I've gone to the extremes here, but there's a lot of stuff in between, and we want to work out a personal investment structure for you that makes sense for your goals, where you are in age, the money that you have now, the money that you need in order to accomplish your retirement plan, but also who you are as a person, something that we call emotionally sustainable as well as being economically achievable. So I hope that's helped further explain the survey. There's more to it. I could go on for hours. If you'd like to chat in greater detail about your situation, give us a call, shoot us an email, schedule an appointment. We're here to help. And thank you very much for listening.